Banks and credit unions. So these generally aren't like the big name banks that you hear and see a lot of, like the Bank of America and Wells Fargo's. But the banks and credit unions that participate in financing real estate transactions tend to be more of your local community banks. Generally speaking, they're going to be the most cost competitive. You're going to get the lowest rates and probably the lowest fees because banks have the lowest cost of capital. Again, for the most part, it's going to depend on the bank, but most of the banks are going to also be able to offer you a reasonable amount of scale. Depends on the size of the bank, but most of them are going to have the ability to give you several millions of dollars, depending again on what your credit profile looks like and the deals that you're working on, but most of them can offer some of that scale. The other nice thing about local banks is they do value that local expertise and those local relationships, particularly if they have a perspective on the local real estate market and interests in having some amount of their bank dollars invested in the local community. The big con for the banks is you're going to have a very thorough due diligence process. So all of the things that we talked about with the institutional capital partners with credit and background and appraisals are going to be there. The banks also typically operate through what are called credit committees that usually only meet maybe every other week or once a month. And every loan typically has to go through that credit committee. So if you've got a very quick turn time and a quick close, it may be difficult for you to actually get the financing from the bank just as a function of how often they meet at the credit committee level to actually get your loan approved. The most thorough due diligence that you can expect, and it moves at the pace of the bank. And oftentimes there's not, unfortunately, a ton of flexibility there to help operators get what they need. The other thing that you just have to look out for banks is similarly on the draw process. So they're likely going to hold the renovation budget dollars back. Some of them are good at this, right, and processing draws quickly. Others are not because of, again, how they're set up from a risk management perspective, which can really slow your project down. So again, not always the case, but something to be aware of. And similar also to the institutions, they tend to be less flexible. Banks are regulated entities. They have to follow, the policies and the procedures and the different rules that the regulatory bodies put out for them, which creates much less ability for them to be flexible, even on things that seem to make a lot of sense. Sometimes their hands just get tied by the fact that they are a regulated entity. And then I should say, I guess the last thing with the banking, if you're going to go that route that you should be aware of, is sometimes they require you to move your banking relationship to their bank. So let's say you find a local credit union or a local community bank that says, really want to support your business and make you the loans you need to buy the real estate assets that you're looking to buy. However, you got to move your entire banking relationship. So obviously not the end of the world, but sometimes can be inconvenient to move all your operating accounts and different things like that to a new bank. So again, a good question to ask if that's the route you're going to be going down. So to bring it all together, really in my mind, there's 5 different types of capital. You've got your friends and family and private money lenders, and those two tend to be, particularly if you're getting started, where a lot of people first get capital to get their businesses going. There's a lot of flexibility there. There's an ability to leverage your relationships and the local market expertise to get started. Same with kind of if you're going to structure that as private money equity. As you gain more experience, as your business grows, as you're looking to optimize for different things, you can graduate often into the institutional capital lenders who, again, are going to give you that virtually unlimited amount of scale, a certain level of expertise to help you continue to level your business up. White glove service, many of them, in terms of helping get your loans closed and again growing the company. And then last but not least, the banks and credit unions, which for certain types of projects can make a lot of sense, particularly if you have longer lead times and cost of capital is really important to you. It is a good source of capital to explore, particularly if you've got a good local community bank in the part of the country that you operate in. The last thing that I'll say in all of this is like these sources of capital are not mutually exclusive, right? So a lot of our customers operate in all 5 of these different capital sources. They're still using friends and family money for a certain number of deals. They've got private lenders that they've got relationships with over the years that they continue to do some stuff with. They do some things with us. They maybe have some banking relationships. So it's not like you have to pick one of these and really build your business around it. We think there's some better places to start if you're just getting going. But as you grow and as your business grows, the access and the types of access of capital that you have to should also grow, and you should be thinking about how to do that as early as possible.